Welcome to the InterMarket Analysis video update. This is a video that I prepare and post once a week where we look outside of the S&P 500 at other stock indexes to see if that gives us any insight as to what's happening. And we also look at other markets to see if that can give us some clues, because no index or market exists within a vacuum, especially the S&P 500. It has lots of variables coming from different directions. This is being prepared for Monday, September 18th. Before I get started on this past week, I did do a free online course. I will be posting the videos for that. They're 1 hour long each, and I did 3 sessions. So if you're interested in that, you might want to check that out. The first session, I talk about my approach to technical analysis, more my philosophy and how I've come to the conclusions that I've come to. And then in the second session, I talk about some strategies that you might want to consider. And then in the third session, I talk about support and resistance. The first area that we talk about in this video is S&P 500 valuation. We look at it in 2 ways. We go back and look historically, what can we look at as to what's already happened and how is that influencing current valuation? And then we look forward to see what is being projected for the stock market to latch onto to justify either going higher or lower. The first chart that we look at is historical. It's the trailing 12 months, and we have the PE ratio, the price to earnings ratio, and these are established with some static numbers. When you have a really high ratio, PE of 20 or greater, the index or that stock is considered to be expensive. When you're at 15, you're fairly valued. When you're at 10, you're considered to be inexpensive. And we can see here, the black line is the S&P 500, where we have been falling back a bit lately. And then the line that is closest to where we're at right now in price is the PE ratio of 20. And we're well above that. So we're considered on a historical basis to be expensive. And then down on the bottom, to give you a little bit better look at this, I take the current price of the S&P and subtract the PE ratio of 20. We can also look at this on a historical basis, going back to 1980 and different events that have happened and what the valuations were historically at that time. We also look at a different way, again, looking historically with the Shiller PE ratio, and this takes things over more of an average period of time to try to get more insight that way instead of allowing for anomalies that may occur. Currently, the Shiller PE ratio is coming in at 30.59. To give you some perspective, the median and the mean is between 16 and 17. So we're almost double where we're at right now based on what we have been over time. We also look at this chart to get some historical context. Back in 1929, we can see the value there, and we're still above that level, even though we've been falling lately. We also have the 1987 crash, and we can compare it to where we're at right now. What's justifying this really high ratio is that earnings going forward are still looking good, and that's what the market uses. They use a forward-looking PE ratio, and as of the 15th of September, the S&P is coming in looking forward at 18.6. So we're under that 20 level and above the 15 level. We also like to look at the mid caps, and they're coming in at 13.5, and the small caps are coming in at 13.1. So that's justifying stocks staying at these elevated levels. Now, we're going through some gyrations in the market right now. We have some weak seasonality, but ultimately what drives stock prices are what earnings are going to be, and we're trying to find that sweet spot between forward-looking fantasy and historical-looking reality, and okay, what kind of a conclusion can we reach right now? We don't necessarily use this to make our day in and day out decisions. We just want to know the overall climate of the market, both on a historical basis and on a forward-looking basis. We also plot all of these together, the S&P 500, 400, and 600, and they have a tendency to move in the same general direction. So we can just see this graphically. And then we have 2 different indexes that we follow for the small caps. We have the S&P 600, that's the blue line, and that lines up with the 10, 15, 20 scale that we use. Well, there's also the Russell 2000, another popular index, and it's coming in at 21.6, but it's handled a little bit differently. So we don't want to take that and apply that same scale to the small caps. We also look at growth versus value. When we're really going higher and the indexes are more positive, that's when growth is doing well. When we're running into some trouble or things are going down, that's when value tends to perform better. So first of all, we look at a peer growth index, and we did cross over positive recently, and this is trending higher. We look at a peer value index where it was getting close here, but we're still seeing a decline. But when this becomes interesting is when we compare the two. On top, we have a growth to value ratio showing how growth is outperforming, even though it's been seeing some weakness lately. And on the bottom, we have value to growth, showing how value has been underperforming, even though it's been bouncing back up recently. Then we look at some ETFs, a growth ETF and a value ETF, and showing how the growth ETF is outperforming. Then we look at the value ETF and show how it's underperforming. We look at some other indexes showing how growth continues to outperform and how value is underperforming. And then the last one, we look at a growth to value ratio from some indexes, again, showing how growth to value is outperforming. The reason I look at all these different charts is ETFs, indexes, peer growth, they're all calculated slightly different, and we want to make sure we're seeing the same things at the same time. And then another area to take this growth and value a little bit further, we have another study that we do showing that even though we've been coming down, growth has been outperforming value. And then an inverse of that shows how value has been underperforming growth. Then we look at the small caps and we compare small cap growth to small cap value. It has been coming down lately, but longer term, it's still in an uptrend. And we're seeing kind of that same thing with the mid caps, longer term uptrend, even though some recent weakness. This is the one that we pay attention to for the S&P 500. We're pretty much going sideways. We're seeing some recent weakness here, but longer term, this is still in an uptrend. We also keep an eye on inflation. We look at the CRB index, and this is a monthly chart where it's switching back to an uptrend. We compare that with a ratio down below between inflationary areas and deflationary areas, and this is continuing to fall, suggesting that even though the CRB index is doing better, it's not really the inflationary areas that are picking up and taking over, at least yet. We look at the CRB index by itself, where it is showing some strength overall. Now, there is some concern about this going back up, because when these go up, that a lot of times will bleed over into the economy and be inflationary. So we want to keep an eye on this, but right now it doesn't seem to be a problem, unless you're trying to fill your car with gas, and we'll see that. Here's the Baltic Dry Index. What does it cost to ship products from one place to another, specifically in the Baltics? And this is continuing to drop, even though we're seeing a little bit of a bounce up recently. Some other markets, and we don't trade these markets, we just look at these markets as something is happening, just to get a gauge as to what is the overall climate, where aluminum still continues to be in a downtrend. Corn is also in a downtrend. Wheat, it's been bouncing around quite a bit, but it's still in a downtrend. Keep an eye on fertilizer. It's been starting to come back up, but not necessarily in an uptrend yet. Oil, this is probably what you feel most directly, where oil is now crossing back above 90. Now, oil can go up when stocks go up at the same time, and we've seen that happen before. This time, it's a little bit different because of the reason why oil is climbing. A few weeks ago, Saudi Arabia and Russia came out, who've already cut back on their production. They came out a week or so ago and said, we're going to keep doing that at least till the end of the year. And that's pushing prices up. There's a real demand for it, but the supply is less. And so that's why prices go higher. And this is filtering over into other areas of the economy. And because of how it all worked out, it's not necessarily seen as positive. It's seen as more inflationary. We look at gas, which is also starting to go back in an uptrend. Keep an eye on diesel, also starting to go back up. Heating oil, starting to go back up as well. Natural gas, it's still not really climbing all that much, but it is bouncing from lower levels. And then we keep an eye on copper. This tends to tell us what do we look like going forward economically. When copper's going up, the economy tends to be better. When it's going down, the economy is showing weakness. We've seen a recent death cross on the daily chart, and we're starting to look more weak on the weekly chart, showing that copper has now been starting to decline. We compare copper to gold. When copper's doing well and outperforming gold, generally that means the economy is doing better. When gold outperforms, that means that maybe the economy is having some problems. We're pretty much going sideways right now with this overall ratio. We look at a longer term version of that, and we also plot the 2-year yield and the 10-year yield. These tend to not get all that far apart, and they tend to move in the same direction. Well, they're not really doing that, but this has been happening now for over a year. So we're seeing this real anomaly still continue as the economy is figuring out what it's going to do. We look at gold all by itself. It's still in an uptrend, but seeing some weakness. If we see some more follow-through weakness, this could lead to a death cross. Seeing kind of that same thing with silver, where it's dropping below its 200-day moving average. It's still in a longer-term uptrend, but starting to show some weakness as well. We look at just the closing values for gold on top, silver in the middle, to show that the correlation between the two is quite strong, which is pretty much what you would think would happen. And then we take a study of that. We look at the gold to silver ratio on top, and then we compare that with the US dollar index and some generalizations that we can make when the US dollar index is going up, like we're seeing over here where I'm highlighting. Gold tends to outperform silver. When this is going down, silver tends to outperform gold. But please be aware that they could both be in uptrends. Gold and silver could be going higher, and one could be outperforming the other. That's also true if they're both going down. We also look at the bottom to see that the correlation between the top chart and the middle chart is quite strong now after it had been out of balance there for a bit. We keep an eye on the US dollar index, which is still hanging in there just below the 105 level. And if this stays above both of these moving averages, we might see a golden cross here. We've already seen a golden cross on the weekly chart, and that's because the moving averages never got that far apart from each other, so they crossed back over quicker. Well, if we see that, this might be a confirmation that we're seeing some strength in the dollar. And that is typically negative for stocks. When we were really going up in 2022 with the dollar, that's when stocks were under a lot of pressure. So we want to keep an eye on this area. We look at the euro, which is longer term, still in an uptrend, but more in the short term, it's coming down against the US dollar. And then we look at the Japanese yen, and I have an individual chart of this to show you where it is in a downtrend compared to the dollar. Here is the Japanese yen showing how it's underperforming the dollar, and the British pound, it's still in an uptrend, but seeing some weakness here. We'll have to see, are we going to drop below the 200-day moving average and possibly turn this this index down? Looking at some index ratios, we're seeing where the equal weight index is underperforming the S&P 500, and that's because you have a number of really big companies that are, if they're up, we have an up day. If they're down, we have a down day, where the broader market is not participating as much. We look at a ratio between the S&P 500 and the CRB, where they're both doing well, even though the S&P has been under some pressure, and that's why we're seeing this coming down, but the S&P continues to outperform. We're going to be watching this to see if we fall below this red moving average and eventually see a death cross here. We look at an inverse of that same chart showing how the CRB has been underperforming, but bouncing back recently. Then we look at the NASDAQ 100, the big stocks that are mainly tech, and we compare it with the S&P 500, and both have been doing fairly well. Not so much lately, but in 2023, they're both up strong. This is still suggesting that the NASDAQ 100 is outperforming the S&P 500. We compare the S&P 100, the biggest stocks in the S&P, with the S&P 500, and they're continuing to outperform. We look at the NASDAQ, which has been doing well in 2023, and the S&P, it's still showing that the NASDAQ is outperforming the S&P 500. We look at the NASDAQ 100, the really big stocks, and compare it with the rest of the NASDAQ index, and the big stocks continue to outperform. We look at the mega cap, which is the really, really big companies, and compare it with the equal weight index, showing how the mega caps are still really in control. We take a ratio of the small caps to S&P 500. That's the red line, and this is a concern. We've been seeing this ratio really going down. In a real good, solid environment, we want to see this ratio going up, especially when we compare it to the blue line, which is the S&P 500. We look at the ratio between small caps and the S&P, and they continue to underperform. We look at the biggest software companies, seeing some weakness now, coming down to their 200-day moving average, but still in an uptrend. The mega caps, these are the really big companies. They are still in an uptrend, but seeing some recent weakness. We look at the robotics and AI ETF, which that's all the craze right now, but the ETF is just not doing very well. And it's doing even worse when we take a ratio between the tech sector and this ETF. The Dow Jones Composite Average. This takes the Dow, the transports, and the utilities and puts them together. They've been chopping sideways quite a bit in 2023, but they're still in a longer-term uptrend. We look at the S&P 500 and compare it with the 1 to 3 year bond ETF, showing that stocks are still outperforming bonds, even though we've seen some recent weakness. We look at a broad market measure, so all of the stocks, and compare it with further out bonds, also showing where stocks are still outperforming bonds, even though we've been chopping around lately. The low volatility ETF, this has been pretty much going sideways. It's still it's going back and forth. It held up better in 2022. It's not holding up quite as well in 2023. We look at that on a performance ratio with the S&P, where it's really underperforming, but we came down to this previous bottom, or got close to it, and we're starting to bounce back up. And we're wondering, is this the start of something, or just a little bounce before this ratio continues to go lower? We also look at the tech sector and compare it with 3 to 7 year bonds. Even though we're seeing some weakness now, the tech sector is still outperforming. We look at the S&P against some other stocks. We have a broad range advanced decline line study. On top, we have the NYSE just common stock advanced decline line, where it's below its moving average, with the S&P 500 dropping below its moving average. The mid caps are also showing weakness, and the small caps are showing even more weakness. We look at traditional Dow theory. That's what we see on the top is the Dow, where it's still hanging out above this breakout point. We're seeing a little bit more weakness in the transports, and that's a concern. We want to see the transports doing really well. That gives better support to the S&P. We're also seeing where utilities have been weak, and that often gives support to the S&P, but lately they've been bouncing back up. We look at a ratio between the transports and the S&P. When this is going up, that means the transports are outperforming. Well, they're going back down, even though we saw a little bit of a bounce up late last week. We look at a ratio between the Dow and the transports. When this is going up, the Dow is outperforming. When this is going down, the transports are outperforming. And we have been going back up, but we ticked down just slightly in Friday's session. We look at the correlation between the S&P and the transports. Sometimes it gets pretty strong. Now it's trailing off just a little bit. And we look at a new take on Dow theory, where instead of using the Dow, we use the S&P, and instead of using the transports, we use the NASDAQ. And we're not really seeing anything alarming that we're not seeing in other places right now. We're looking for divergences and convergences here, and they're pretty much confirming each other. We look at the FANG index, which had been holding up nicely above its 50-day moving average, only to close a little bit below that on Friday. But longer term, it's still in an uptrend. We're also watching this, where we came back and set a new all-time high, and we've been having a lot of trouble since then, and we have not been able to come back up to this other area, which is providing overhead resistance. ARC, which is still in an uptrend, but seeing some weakness and rolling over a bit, but it's still positive for right now. We look at the S&P 500 and compare it with stocks in Europe, Australia, Asia, and the Far East, where we're above the moving average. So that's positive, even though we're ticking down. This is a monthly chart, so it takes quite a while for this to readjust. We look at the percentage price oscillator, or PPO, on the bottom, and that's continuing to advance above zero. So even though we're seeing some weakness right now, we're holding up, at least for this time, at this time. Comparing bonds versus stocks, we're starting to turn negative with the total bond ETF. We're also turning negative with the World Bond Index. And that's just showing on a monthly chart how stocks are outperforming bonds. This is also showing how bonds are underperforming stocks. The high yield bonds, these are junk bonds, and they're continuing to do quite well. You might want to say, okay, if we were getting ready to really have some problems in the economy, would this be going up the way it is? Probably not. Now, we're starting to see some weakness in investment grade bonds. These are more corporate bonds, really more conservative bonds, and they're starting to show weakness, and we're seeing a death cross here with this ETF. We look at riskier bonds and compare them with more conservative bonds, and the riskier bonds are continuing to outperform. We do a correlation between stocks and bonds. They're having a slight tendency to go in the same direction, but this relationship is showing some weakness. We look at the corporate bond index, and this is starting to cross over negative. We've been chopping sideways for a lot of 2023, but now we're dropping below both moving averages, and we're seeing a death cross now, so that's switched to negative. The 10-year yield, we're breaking out above this 100% retracement level, and we're still above that point for right now. We're looking at a long-term yield of the 10-year where we had been seeing a series of lower highs and lower lows for about 40 years. And we're wondering, as we're going back higher, is this shifting back to what it used to be, the old normal, where this 40-year run is more the new normal? We don't know that. We're just kind of watching this to see how things play out. If interest rates end up going higher and then staying at higher levels, that will be what we'll switch back to, which is very different than what a whole generation of investors have been witnessing. So this is kind of new. Looking at the 30-year yield, where we're above the 61.8% retracement level and not really showing anything when we look at the Fibonacci levels. We're looking at the S&P 500 and comparing it with the 10-year yield, where it had been outperforming. Well, now the S&P is starting to underperform the rise in interest rates, as we're seeing pressure in stocks as interest rates are going up. Looking at the junk bond ETF, still in a solid uptrend. We compare junk bonds with government bonds, and junk bonds are really outperforming. We look at a daily chart of the 70-year ETF, where we're seeing some weakness now. With the RSI, we're below 50 and declining. We've seen a recent death cross, and the MACD is starting to roll over negative. We look at a daily chart of treasury yields going from 30 years all the way down to 3 months. This just gives us an idea of how things are moving, even though we're seeing a lot of inverted yield curves still. Here's a weekly chart looking internationally, where the UK has the highest rates, followed by the US and Germany. We're seeing the Japanese rates go up slightly, but we're keeping an eye on what's happening there. Here's a study of the 5-year yield. Now, this is the interest rate on the 5-year, where it's clearly in an uptrend, but we're seeing a real contradiction here with the special K. It's showing that we're more going down. And with the KST, this also shows it's going down. I would tend to focus more on the fact that we're still above this red moving average, and rates are clearly going higher. Also, another study, in the short term, we're going pretty much sideways. In the intermediate term, it's going up, but long term, it still has us going down. And again, that seems to contradict what we're seeing on the chart above. We look at the price of the long-term bond ETF, where it's clearly going down. In the short term, we're declining, intermediate term, we're declining, and for some reason, in the long term, it hasn't rolled over, at least yet. Looking at the MOVE index, which measures the volatility of bonds, we compare that with the VIX, which measures the volatility of stocks, and we see that they have a fairly high correlation to each other. We look at the 30-year price of the bond on a monthly chart, and we compare that with the CRB. Even though the CRB is seeing strength and the 30-year bond based on price is seeing weakness, we're seeing it really going down here. Bonds are still outperforming the CRB index. This is a monthly chart, so it's going to take a while for this to switch. We look at different sectors in the S&P. Materials are in a downtrend when compared to the S&P 500. Communication has been one of the stronger areas in 2023. Energy, seeing a bit of a bounce back, but still in a longer-term downtrend. The financials got hit back in March with the whole bank issue. We're wondering if that's going to ever come back again. It seems to be under control right now, but that could change at any time. Looking at the industrials, also in a downtrend. Tech, which has been a stronger area, recent weakness, but still in an overall uptrend. The staples really suffering in 2023. That's more of a value area, because these are things that you have to have no matter what's going on in the economy. We look at real estate, which is bouncing back up lately, but in a longer term, pretty significant downtrend compared to the S&P, really underperforming. Utilities also bouncing back up lately, but still in a longer term downtrend. Then we take a ratio between the S&P and the utilities, and when this is going up, that often gives support to the S&P, and it did there for a little while, but we've seen this ratio continue to go up, but the S&P hasn't been going up that much, and now we're starting to fall back a little bit with this ratio. Healthcare, you have to have that no matter what's happening economically. It's still in an underperformance mode when compared to the S&P. Here's another look, also showing how healthcare is underperforming. Discretionary, these are the things that make life more interesting. That's been one of the better sectors in 2023, still in a longer term uptrend. Staples, these are the things you have to have. Starting to get close to a death cross here. We haven't quite crossed over yet. When we look at the tech sector, still in a longer-term uptrend, but seeing some recent weakness. Semiconductors got hit pretty hard on Friday, but still are in a longer-term uptrend. Tech sector compared to the S&P shows that tech is still hanging in there pretty strong. Comparing energy to the tech sector, we're bouncing back with energy, but still energy is underperforming tech. Looking at the growth areas, growth stocks, comparing it with bonds, showing how growth continues to outperform. Looking at the tech sector, comparing it with the rise in interest rates, where the tech sector has been outperforming, but we are seeing some recent weakness. Here's an inverse of that same chart showing how the rise in interest rates has been underperforming, but starting to bounce back up as interest rates go up. And a lot of these big tech companies, they have to borrow money, so interest rates are very influential to them. Comparing discretionary with staples, showing how discretionary is outperforming. This chart shows how staples is underperforming discretionary, and gold is underperforming the S&P. Even though gold is still in an uptrend, it's underperforming the S&P 500. And gold is also underperforming the dollar. High leverage loans. Again, I say this every week. If we were getting ready to fall off a cliff, these are risky loans. Do you think this would be in such a solid uptrend if the economy was getting ready to fall apart? Probably not. Now, this could always change, but it's been going up now for quite a while. The NYSE composite, this is a broad measure, continues to be in a solid uptrend. All stocks also in an uptrend. Emerging markets chopping sideways, getting close to a death cross, but still in a kind of a weak uptrend. And the micro caps, these are the real small companies. They are in a downtrend now. When we're really going to pay attention to this is if we cross below the 100 level. Earlier in 2023, we did set a new 52-week low. But so far, even though we're seeing some weakness here, they're hanging in there. Then we look at the home builders. This is a home builders study. We have the S&P on top, the home builders ETF. We have a ratio between the two. And what we look at the most is on the bottom, the correlation. And it's just suggesting now that they're both going in the same direction. We look for mainly divergences. If one is outperforming the other, that can often give us a warning sign. Bitcoin starting to see a death cross here. It had been positive, but now it's starting to roll over and go negative. Looking internationally, we're trying to turn back up with China, emerging markets, Europe, and Japan's pretty much flat. We're trying to turn up here with the S&P, but starting to roll back over. And then looking at InterMarket Analysis, going back to the beginning of 2023, stocks are in the first place, followed by oil. Then we have the dollar and gold and bonds went negative in the early part of August. Looking at some correlations, we compare the S&P to the US dollar index. They're having a pretty strong tendency to go in opposite directions. The dollar's going up, the S&P is going down, and vice versa. We compare the S&P 500 to oil. There are times when they have a tendency to go in the same direction. Right now, the market's having a tendency to go in opposite directions because of the reasons why oil is going up. We compare the S&P to the 10-year yield, also having a tendency to go in opposite directions. The tech sector to interest rates, also, we were getting to a neutral stage here, but they're having a tendency to go in the opposite direction. We compare the S&P to the 2-year yield, also going more in opposite directions. We look at the long-term secular, which can be decades, and cyclical, which typically means years, trend studies. We look at a monthly chart of the NYSE, and we're still above the moving average here, and the Kopik curve is still looking more positive. So longer term, broader range, we're still holding up, even though we're seeing some weakness. We also look at the NYSE record high percent index. It's turning down just a little bit, but it had been in a pretty solid uptrend. We look at the S&P on a monthly chart, which it's still above the moving average, and we take the percentage price oscillator, and it's continuing to advance. We compare the S&P with the CRB index, showing how stocks are still outperforming the CRB. Even though the CRB's been doing well as the S&P's been under pressure, it hasn't updated on this longer-term chart yet. We look at the S&P and then look at a global index where we're above the moving average, but the KST is still suggesting that we're negative. Again, I would focus more on the price of what we're seeing, and this is looking more healthy. Then at the end, what I do is I line up all of the positive things and then the negative things. My definition of positive is when the 50-day simple moving average is above the 200-day simple moving average. I know that's pretty plain vanilla, but it's a real simple way to evaluate things. The growth indexes and ETFs are positive. The CRB index, the big software companies, even though we're seeing some recent weakness. The euro and the British pound to the dollar. Gold and silver, but that's getting a little bit in jeopardy now. The big mega cap stocks, the low volatility ETF. Another week and we might cross over negative. The Dow Jones Composite Average, the FANG Index, as well as ARK, bonds, the high yield and junk bonds. These are the more risky bonds and they're still holding up. Staples, the tech sector, as well as semis, even though they've had some recent weakness. High leverage loans, the Dow, mid caps and small caps, the NASDAQ and NASDAQ 100, the NYSE Composite, all stocks, and emerging markets. And we're getting close with emerging markets. That might cross over negative if we see more weakness. The negative side, this is when the 50-day simple moving average is below the 200-day simple moving average. The value indexes are still negative. Copper, the US dollar index, although it's showing some improvement. The Japanese yen to the US dollar, the total bond ETF, world bonds, micro caps, the investment grade bonds, which are more conservative bonds, as well as corporate bonds. Those are new additions to the negative list. And then Bitcoin is also a new addition to this list. Thank you. I hope you found this helpful. Please feel free to check out the other videos that I post. I hope you have a great weekend, and I will talk to you in the next video.